Mr. Renacci.
Thank you, Mr. Chairman. I really appreciate you doing this. I hope we can do additional panels like this. It's good to hear different proposals. I really appreciate all of you and your ideas. I'm going to ask you some questions based on a CPA that's been in business and not only practiced as a CPA, but also is in business. And I think every one of your programs has some good points. I'm going to touch on the negative side, and hopefully you can give me some answers on that and just tell me what your thoughts are. First off, Mr. Nunes, I'll start with you. I go back to how I started out in business. I had very little. I was able to go to a bank, borrow some money, get started in a nursing home business. There was a competitor down the road who had a lot more money. So he was able to acquire the asset. He was able to buy the building. I couldn't. I had to just buy the operation and lease it. So he, on the other hand, under your proposal, would have if you're picking winners and losers, he would be a winner. He would have a deduction that I wouldn't have. He'd be able to expense that facility, and I'd be sitting over having to pay 25% tax on my earnings based on your proposal. So the concern I have in that case is the picking of winners and losers. The guy who can afford to capitalize his business and the guy who can't. The small guy like myself. Now, I was successful enough over 25 years to be able to build the business and acquire those assets down the road, but that's because we were in the system we're in today. So that's one question. How do you help me on that one? And the other question is, which is so concerning for me, is without that interest deduction, I would definitely not be able to compete with him, because that's the only deduction I had where he would be able to capitalize or write off his building.
So thank you, Mr. Renacci. We've had discussions about this in the past, and I think you're very thoughtful and clearly have experience at dealing with this. I think one of the challenges that a lot of people have when they first look at this tax bill, the ABC bill specifically, is they look at it through the lenses of an income tax. And that's one of the challenges that I have when I'm dealing with business people, is because they're looking at it like income tax, going to be income tax just like income tax has always been, not realizing that this does away with the income tax for all business activity in the United States, and it becomes a consumption tax. So I would argue that whatever that business model was, because I'm not familiar with how you started out, that would not be the business model if this system was put into place. So for example, how would you do it? Well, I think there would be as I talked about earlier about different equity opportunities that would come up. There would be so many more equity opportunities because you would have so many more Americans that perhaps don't have a lot of capital, but what little capital they do have, they would take risks with people like yourself. Today, those people don't invest. They really have no other options but to maybe invest in the stock market. They have no opportunity to invest into small business. And so I think those types of investors would be open, especially to a small business person like yourself. And so when you come to the end of the year, what you would do if you're continuing to grow as a small businessman, the end of the year, you've got whatever money you have left over, you might want to go out that December and you might want to go out and make investments so that you don't get taxed at that 25% rate that year.
The only other response I would have is that I think I told you this on the floor. I'm not too sure I'd want to have 10 or 12 partners. I kind of like the idea, as you're growing a business, just to have the bank as a partner. Then you just have to answer to one. I wouldn't want 10 or 12 people trying to tell me how to operate, which is the negative side of having equity investors. But I do appreciate, I am supportive of consumption. I just don't know how two business models exactly the same. One has more capital, can buy the building, one who can't. One of them is going to be a winner, one of them is going to be a loser. Mr. Woodall, I do 100% believe what you said. Businesses do not pay taxes. And once we get to that point, if everybody can agree to that, because they pass it on, we can reduce the rate. Explain to me, under your plan, which is the downside of the fair tax, is that somebody has lived their whole life, saved up money, paid taxes at 36%, 38%, whatever, now is sitting with a savings account, they're elderly, and all they're spending, they're going to have a double taxation. They've already paid tax once, they're going to pay tax again. Explain how that is good for that individual.
It's a rotten deal generationally, just the bottom line. We can either decide that because we're stuck in a bad deal today, our kids are going to have to be stuck in that bad deal too, or we can decide we are going to get the bad deal, but our kids are going to do better. But many seniors living at the low end of the income spectrum. Our prebate allows folks up to the poverty level to live tax-free. We insulate Social Security payments against any one-time inflationary jump that may happen because of the imposition of a double-digit sales tax in the economy. Any sort of inflationary jump would be captured in outgoing Social Security payments. And finally, my hope is we would put the economy on fire, and folks, instead of getting a 0.25% on their CD or 2% on their bond, are going to get back into the 6, 7, 8% yields that they deserve.
Mr. Burgess, I know I'm pretty much out of time, but the one question I would have for you is, you said that you can opt into your system. So if I'm not paying taxes today, I'm going to stay in the current system. But if I'm paying 38%, I'm going to opt into your system. That's going to bring the Treasury, the dollars coming to the Treasury, significant down, because everybody's going to pick the lower side, and you're going to have a rate of at least 19% or less, because the people who are already paying less than 19% aren't going to opt in. So how would you fix that disparity?
Well, with all due deference to your profession, the answer lies in the simplicity. Look, I got to visit my accountant every year and make sure I've spent down the equity of my corporation to where I am not going to be taxed. If you elect into, and this would be a voluntary election, no one's going to force you into it, but if you elect into the flat tax, then that is going to be the rate from that day forward. On your question about the difference in treatment for someone who has bought the building and someone who I presume then is renting the building, that is treated equally under the section on inputs, business inputs in the flat tax, whether it is the cost of a building purchased or the cost of rental. It is treated identically for the person who's invested in the building. That would be phased in over time, over the credit allowance over time.
Thank you, gentlemen. I appreciate your input. I yield back.
Thank you.